This is your LMAX exchange technical update for Thursday, February 16th, 2017. Euro dollar. So the euro has seen setbacks extend down towards a low of 105.20 about thus far ahead of this latest minor bounce. But overall, the downside remains intact. The downside pressure remains intact here, and the market is still favored back towards that 14-year low from January at 103.41. The recent break below 106.20 is what strengthens that outlook. And so while we have seen a bit of a bounce, it would take really a break back above highs that we saw back on the 8th of February around 107.15 to take the immediate pressure off the downside. Sterling dollar. So cable has been consolidating over the past several sessions, although it has slowly started to roll over, but it will take a break back below recent support from the 7th of February at 23.47 to officially accelerate declines back towards the recent multi-year plus 30-year low that we saw back in 2016 at 118.41. But only a break back above 27.75 will take the immediate pressure off the downside and suggest a more significant structural shift. Dollar yen. So dollar yen has seen a nice little rally over the past several sessions, but ultimately while the market holds below 115.62, that's the high that we saw on the 19th of January, there is still risk for this market to trade lower. A breakback below recent support around 111.60 would open the door for the next downside extension towards a measured move objective at 109.50. Again, only back above 115.62 will alleviate immediate downside pressure. Euro Swiss. So the Euro Swiss rate continues to hover just over the 2016 base at 106.24, but at this point it does seem like this is a bearish consolidation ahead of that next big drop below 106.24 and towards psychological barriers at 105 further down. Only back above 107.60 would take the pressure off the downside. Aussie dollar. So Aussie continues with its impressive surge. It looked like it was in the process of potentially stalling out after the market was unable again in recent trade this week to establish above 77. But on Wednesday, the market surged through 77 barriers, suggesting that there wasn't going to be this top here and opening the door for the next extension higher towards significant medium-term resistance up around the 78 area. You can see that there's that 77, 79 peak that we saw back in November of 2016. Ultimately, this market is not expected to trade much beyond 78, as that is a significant level of resistance, and we've seen already a very nice run in 2017. So despite this push higher, while it could extend up towards 78, look for the market to stall out at some point over the coming sessions. But at the same time, we still need to see a break back below 76 to strengthen the bearish prospect and accelerate declines. Dollar CAD. So dollar CAD has done a good job holding up after trading down below 130 several days back. The market continues to retain a broader constructive outlook and is now looking to push back towards the top side. It'll take a break back above the high that we saw on the 7th of February at 137 at 132.13 about to officially open the door for an acceleration of gains and resumption of this more significant uptrend in dollar CAD. Kiwi dollar. So Kiwi has seen a nice little bounce on Wednesday, but the market does still remain pressure to the downside, and any rallies here are seen very well capped, with only a pushback above that recent high at 73.76 to negate the current bearish outlook. Of course, a break back below the recent low that we saw in Tuesday trade around 71.35 will further strengthen the bearish outlook and accelerate declines. SPX 500, another day, another record high for the S&P 500, which is only going higher, and it's shown no tendencies to reverse at this point despite overbought readings on the daily chart. At this point now, at a minimum, it will take a break and close back below recent support from Tuesday, which comes in at 23.22 about, to take some very short-term pressure off the top side. Ultimately, initially, we need to see really a break back below 2300 to maybe suggest the market's reversing for a healthy correction, and more significant support comes in at 2232 further down. That's the low that we saw on the 30th of December. A break below there would be a very significant development and suggest a structural shift. But overall, this market has shown no signs of let up just yet, and continues to push higher to fresh record highs. Now looking as it establishes or tries to break above 2350, looking towards that next psychological barrier at 2400 further up. gold. So gold continues to be very well supported on dips. The market recently was supported on a dip below 1200 at 1180, with the subsequent break back above 1220, setting up a higher low at 1180 and opening a measured move upside extension towards 1260 in the sessions ahead. At this point, only back below 1180 would compromise the highly constructive outlook for the gold market.